Welcome to Cashflow Diary, a podcast where we discuss business, money, real estate, and the sharing economy. As a full-time real estate investor, entrepreneur, and all-around problem solver, I have had the privilege of developing individuals into powerful business owners. And today, the focus turns towards you. Our mission is to help you build your real estate empire by leveraging strategies to grow yourself, your mind, and your wallet. Let's get started.
Here is the next deal. Single family house, detached, single family, 4-bedroom, 2.5 bath. BPO value came in at $215 as of 12/21/13. Mortgage is $268. Well, there's a problem. The property owner is out of state and previously tried a short sale but was unable to sell. Interesting. The property was previously listed on the MLS for $150. Pictures from the expired MLS listing. House is in great shape with extremely dated kitchen. I like the word extremely. Realtor contract has expired. Okay, this is good. Fix and flip. Okay, sure, if that's what you want to do. I'm assuming the best way to help the borrower get rid of the property is to help him through the short sale process, which will allow me to buy at a discount. Can you go over the role of the investor in a short sale as a strategy to make an offer with the banks? Got it. Excellent. First and foremost, I don't think a short sale is what you should do. I'm just going to say that, okay? Because if this property has a value at $215 as of 12/21/13, depending on its location, I don't know like the marketplace. If this is in a West Coast market where the appreciation, for example, some markets when you track their appreciation over time, so this being time, when you track their appreciation over time, sometimes some markets go like this, and some go like this, and some go like this. I don't know what type of marketplace this particular property is in. However, here's some of the things that I'm looking at when I look at this particular property. I'm looking at the fact that it's obviously it's negative equity, but that's just one of 4 places where you have the opportunity to earn profit. There are 4 profit centers, and for those of you that have been a part of our private capital mastermind group, you know exactly where I'm going right now. We're talking about the profit analysis quadrant. There are 4 profit centers inside of every transaction. So you've got your appreciation, depreciation, your amortization, and your cash flow. So some of the initial questions that I'm wanting to know on this particular deal is, how far are they in arrears? Because if they're not too far in arrears, you may be able to take the loan over. It may make sense to take this property over subject to, because you've only eliminated one of the 3, and that one for a short period of time. I don't know how long this loan has been in place. Say if this loan has been in place for 10 years, it could be worth keeping this loan, especially if it's at the right interest rate. Again, I don't know, but the point is, this is where additional questions come into play. But you have a way to be, the loan balance right now is $268,000. If this is a fixed loan, your worst case scenario is that you will have earned a few $100,000 worth of amortization if you hold this property. Okay. So let's call that, was it $215? So you have a potential of $215,000 in here over some period of time, depending on what the loan balance is and the loan term is. Depreciation, you're going to have a percentage of that given to you every year, and this is going to end up becoming dollar for dollar tax write-off. For example, I'll show you on the calculator. Let me see. Let's turn to the calculator. So with the depreciation number, I'm going to use the entire $215,000 number. So that $215,000 number is going to get split into a portion of it is going to get split into the property, and a portion is going to be split into the land. So to be very, very simple, I'm just going to use an 80-20 split. And it's only the portion that's split into the property that you get to depreciate. This is a single family house. So you have $172,000 that you can depreciate, and I'm going to use what is known as straight line depreciation. Now all I'm going to do is divide that by 27.5. That's around $6,254.55. That's the number that we want to track and write down. So it's $6,254.55 on an annual basis. what we're going to do is we're going to take that number and multiply by our tax bracket. So in this case, let's assume a 25% federal and a 5% state. You may be higher, maybe lower, but you're going to see my point here in a second. And I'm going to multiply that by 30%, and it could come out to an $1,800 a year credit, $1,876 it looks like, and 36 cents. The whole point being is that you've got some money here and you've got money here that you can be making and earning by just taking control over this property as opposed to just fixing it, because it may be more advantageous to do so. We haven't even talked about the cash flow because I don't know what the mortgage payment is, how far they're behind. But even if this is zero and break even, you still have two parts here. So in theory, it is possible to have a break even property that has negative equity and still be able to earn some money. And that's kind of what I want to draw your attention to before we go, hey, let's just fix it and sell it and be done with it. That may not be the best avenue here. However, you asked about the short sale process. First of all, what I want you to understand with the short sale is that the short sale is actually a long purchase. Okay? It's a long purchase. That simply means it doesn't happen quickly. Okay? However, once it does happen, you can do many things with it. You may be able to get it to go down to whatever current market value is, but it doesn't sound like current market value is too depressed. So it may not be worth the additional time. Again, I don't know condition. So those are the things that that's what you're going to hammer on. You're going to get the property under contract directly with the owner, then present that offer to the bank and then negotiate directly with the bank in order to make that possible, dare I say, probable for you to do so. Now, if you've never negotiated directly with the bank, I'm going to suggest strongly that you don't go out first time and do that. You get some education, or you get a partner who has negotiated directly with the bank. I'm going to see and again, for those of you that have listened to the podcast at all, we have there is a company that does short sales. These guys right here do short sales. And what they do is they do the negotiation. You go out there, you get it under contract, they'll do the negotiation for you so that you have the ability to continue with the process from that point forward. Unless, of course, you just want to go and negotiate with the bank. You're free to do so, but again, totally don't recommend it. So I'm assuming the best way to help the borrower get rid of the property is to help them through the short sale process. No, I don't think so. Which will allow you to buy at a discount. Can you go over the role of the investor in the short sale? The role of you as the investor, you're going to be the buyer. You're always the buyer. And that's what it comes down to. You would present yourself as the buyer to the bank, and you would go from there. And if you use companies like shortsalesapproved.com, they would be able to assist you through the process, regardless of where you are in the U.S. to get that stuff done.
Thank you for tuning in to the CashFlow Diary podcast. If you enjoyed this episode and you'd like to help support the podcast, please subscribe, share with a friend, and leave a rating and a review. If you'd like to keep the conversation going, head over to CashFlowDiary.com to sign up for our email list, as well as check out all the links and resources in the show notes. Thank you again. Until next time.